Hi, this screencast is looking at the audit opinion, the external auditor's opinion, and modified opinions, where there's some material or pervasive problem or issue with the financial statements and the auditor has to modify their opinion in some way. The way the question normally comes up is you're asked to, as it says here, discuss and justify the type of audit opinion you intend to issue for a number of scenarios. So in this question there are 4 scenarios. So here's one scenario, and on the next page then there are the 3 other scenarios. So it's important to know the theory. So I'm just going to run through the theory first, then I'll finish this screencast, and then I'll start another screencast after, which goes directly into looking at questions and answering them. So you need to know this table, and these are the type of modified audit opinions. So all of these 4 opinions here are modified. So there are 2 types of circumstances where there is an uncorrected error, where the auditor knows there's a mistake being made, where the accounts are not in accordance with the Companies Act or accounting standards. There's an uncorrected error. Depending on the size of the error, then it's either immaterial if the error is less than 5% of profit before tax. That's a normal, and that measure of materiality is what we use quite commonly, but it's not suitable for every circumstance. So we look at materiality, and I've looked at materiality in other screencasts, so I'm not going to go into it much here. So I'm just going to use the 5% of PBT. So it's material. The errors will affect the decision of a user of the financial statements if the error is greater than 5% of profit before tax. So it's material if it's greater than 5%, and then pervasive if the financial statements as a whole are unreliable, if the error on its own, or if there are lots of errors, are enough to make the financial statements as a whole unreliable, then it's pervasive. That's so very small error, bigger error, and then lots of small errors all around the place, or one big error which really make the financial statements as a whole unreliable, that the user should not rely on them. So the other type of circumstance is a limitation of scope, where for some reason the auditor was unable to obtain sufficient appropriate evidence. And what that means is there may be errors, there are possible errors. So the auditor can't say the financial statements are true and fair. So an unmodified opinion is where the auditor says the financial statements, in our opinion, the financial statements are true and fair. A modified opinion, where it's one of these issues, the auditor can't say that. So if there's an error in the financial statements and it's material, you give a qualified opinion. So, and that's where the auditor says, in our opinion, the financial statements are true and fair, except for the error in inventory or in non-current assets, and the issue is explained. Where there is a limitation of scope, where the auditor was unable to obtain enough evidence, appropriate evidence, and the size of the area about which they were unable to obtain enough evidence is material, then the auditor gives another qualified opinion, same as here, except you can't say there's an error in it. What you say is the financial statements are true and fair, except for possible errors, and you say where the area is, and then about which we're unable to obtain sufficient appropriate evidence. So it's very important you see the difference there between this says except for the error. That says except for possible errors. So that's the difference when you're given the qualified opinion. And then you have to say unable to obtain sufficient appropriate evidence. Whereas when the auditor, when there is an error, the auditor knows there is an error, and they can say in their opinion the financial statements are true and fair except for the error in such an area. If the issue is pervasive, then it's adverse opinion. Financial statements are not true and fair. So in our opinion, the financial statements are not true and fair. If it's a pervasive limitation of scope, and we look at examples of these, the opinion is not given at all. It's a disclaimer of opinion. So I'm unable to give an opinion on the financial statements due to not being able to gain sufficient appropriate evidence about, and the auditor will give more detail. And for any of these four options, under the opinion, there is called a basis of opinion paragraph, and that's where the auditor gives more detail about the modification. So here is the way you approach questions. You read the question, the scenario, and you need to establish if there is an error or a limitation of scope, if that's the issue. You explain what the error is, so you'd have to explain the accounting mistake that was made, or if it's a limitation of scope, you'd have to just talk about the auditor not gaining enough evidence for whatever reason and explain why, and maybe discuss if there was other ways of getting information. But in these questions, there won't be other alternative sources of evidence. Then the next issue, once you know it's an error or a limitation of scope, then determine the materiality. And once you've won in step 1 and 2, then you can determine the audit opinion by looking at the table we looked at earlier. So an error is where the auditor knows there's an error, so there is something accounted for incorrectly, or there's an item disclosed incorrectly in the notes. So it's not just the P&L and balance sheet we're looking at, or the income statement. You're looking at the cash flow statements, the notes to the financial statements as well. And the client will refuse to correct the error, and this causes a disagreement. So sometimes you see it being referred to as a disagreement. So in any answer, you have to explain the accounting rules in relation to the issue about which there's a disagreement. So if the problem is that the client did not record a provision when they should have, then you have to explain what the rules are for recording a provision. Or if it's revenue and capital expenditure, you need to explain the difference between revenue and capital expenditure. So the financial statements include these areas, but we really, in most questions, to look at the first three: the income statement, balance sheet, and the notes or disclosures. And you're looking for mistakes that were made, errors, or else limitations of scope in relation to these. So a limitation of scope, you need to clearly state the auditor was unable to obtain enough relevant evidence about the matter due to whatever the limitation of scope is. And then you should also discuss, maybe because you won't be able to discuss an error in accounting rule, so maybe you should say perhaps the auditor should obtain evidence by other means. And definitely, as I said here, you should not be explaining an accounting rule here. You only explain the accounting rule when there's an error. So examples of errors, and these are pervasive errors. So where the client refused to write down inventory to the lower of cost and net realizable value. So where the net realizable value is less than the cost for some reason. And then it's pervasive if the misstatement of inventory is greater than 40% of profit before tax. It would be material if it was greater than 5% of PBT, and immaterial if it was less than 5% of PBT. So incorrect going concern assumption used would be an error. A material uncertainty, failure to disclose, so something in the notes, and depending on the circumstances, this could be material. So if the client incorrectly capitalized repair costs as additions to non-current assets and they refuse to correct, well then that's an error in the accounts. And particularly, depending on the size of it, you can determine the materiality. If it's greater than 40% of PBT, it's a pervasive error. These are other examples of errors. Here are examples of limitations of scope, and they're all pervasive examples. So the percentage of PBT is going to be greater than 40%. But they'd all be material if they were just less than 40% and greater than 5%. Between 5 and 40% is material. And if the issue or the size of the potential problem was less than 5% of profit before tax, they'd be immaterial limitations of scope. So just for now, concentrate on the why the lack of evidence, or why there is a lack of evidence. So receivables did not respond to a receivable circularization, and not enough other evidence is available. That's an example of auditors not being able to get evidence on receivables. So there's no error here. So it's important that you can see the difference between an error and a limitation of scope. Lack of evidence over tangible assets. So you're unable to inspect the assets as held in a foreign location. Or another reason would be auditors unable to inspect assets because they were held in third-party locations outside of the client premises, and the client wouldn't bring them back to get them inspected. Lack of evidence over closing inventory. Okay, you were appointed after the year-end inventory count took place, and therefore you missed that really important audit procedure. Well, it's the client procedure, but the auditor should attend the inventory count normally and carry out their own procedures during it. So if you weren't able to attend, that affects your ability to gain evidence. Okay, lack of evidence over intangible assets. A fire during the year, all records were lost, and no other evidence. So once again here, there's lack of evidence. We're not saying that the amount of 30 million is incorrect. It's just that the auditor doesn't know if it's incorrect, because they haven't the backup to prove the figure. Same with project costs here. A key employee left and took vital records with her, and that means the auditor cannot tell if that's correct figure or not. So you've got a limitation of scope. So once you know the difference between an error and a limitation of scope, then you determine if it's an error or limitation of scope. Then you look at the materiality. Normally I'm saying we use the quantitative calculation of something is immaterial if it's less than 5% of profit before tax, and it's material if it's greater than 5%. And qualitative materiality. These issues are always material even if they're less than 5% of PBT. Sensitive areas such as directors' remuneration, related party transaction, disclosure notes. And I suppose the overall guidance is, as it says here, if part of the financial statements can be relied upon for decision making, then the matter is material and not pervasive. And here is pervasive. So there are the examples, and then the effect of the pervasive error is to make the financial statements as a whole misleading. So you can't rely on any of them. And then really it's a matter of professional judgment and experience. So it can be difficult for you to determine it. But if when you talk about pervasiveness, if you say the words that it's pervasive error and it's made the financial statements as a whole misleading or unreliable, well then that shows you know what pervasiveness is. And then you're back down to this table, and then it's applying that to scenarios. So that's what I'm going to do in the next screencast, is apply this table to the scenarios. So thanks for listening.